Picture this. You're 28 years old. You've got a decent job. You make about $55,000 a year, which after taxes gives you roughly $3,200 a month to work with. You're doing the responsible thing. Every single paycheck, you move a couple $100s over to your savings account. You pat yourself on the back for being financially disciplined. You watch the balance creep up slowly. 3 months in, you've got $600 saved. 6 months in, you've got $1,200. A year in, you've got $2,400. You're starting to feel like you've got your finances figured out. You've got a safety net. You're secure. You open your phone and check the interest rate your bank is paying you on that savings account. It's 0.01%. That's not a typo. 0.01%. On your $2,400, you're earning roughly 24 cents a year. You're literally making less than a penny a day. But that's okay, right? Because it's safe. It's in a bank. The government insures it. You're not taking any risks. You're being smart. You're being responsible. You're doing exactly what your parents told you to do and what every financial literacy commercial on late night television tells you to do. And yet, here's what absolutely nobody tells you. That $2,400 you've saved so carefully, that money you've deferred spending on to build up a nest egg, is actually getting smaller every single day. Not in your bank account, obviously. The number will always say $2,400 until you add more. But in terms of what that money can actually buy, it's shrinking fast. My name is Ian, and I spend way too much time obsessing over the invisible math that makes people feel rich while they're actually getting poorer. If you're someone who's been doing the responsible thing by saving money in a bank account, or if you've ever wondered why your savings account feels less useful every year, even though the balance is going up, make sure you hit that subscribe button and give this video a thumbs up, because today we're going to talk about one of the greatest financial scams nobody's calling out. A scam so invisible, so normalized that you probably don't even realize it's happening. We're going to expose why keeping your money in a savings account isn't just a bad financial decision. It's the single best way to guarantee that you'll stay poor. And more importantly, we're going to show you exactly what to do instead. Here's the fundamental problem with savings accounts. They've become a tool for losing money that feels like saving. The math is so depressing it should actually shock you. The average savings account in America right now pays about 0.01 to 0.05% interest annually. Some high-yield savings accounts are doing better. Maybe 4 to 5% if you shop around. But most people aren't shopping around. Most people just throw their money in their checking bank's savings account because it's convenient. And that account is paying them effectively nothing. Now, here's where it gets really interesting. Because while your savings account is paying you nearly 0%, inflation is eating away at your purchasing power at a rate of about 3 to 4% per year. You don't notice it in the moment because the number in your account never changes. But every single year, your money buys less stuff. That $2,400 you saved a year ago, today it can only buy what $2,300 could buy back then. You didn't lose money in the traditional sense. You got robbed in the most invisible way possible. Let me show you what this actually means in real dollars. Let's say you're 25 years old and you've decided to be financially responsible. You're going to save $5,000 a year for 40 years until you retire at 65. That's $200,000 total that you've deferred spending on. You've sacrificed nights out, vacation upgrades, nicer clothes, all of it to be responsible. 40 years of discipline. You open up your savings account on your 65th birthday and there it is. $200,000. You did it. You saved 200 grand, except you didn't. Due to inflation averaging 3% per year over those 40 years, that $200,000 can only buy what about $60,000 could buy back when you were 25. You spent 40 years saving for a retirement that was already going to be half as comfortable as you thought. You didn't accumulate wealth, you deferred it into irrelevance, and the banks made out like bandits the entire time because they took your money, paid you essentially nothing for it, and lent it out to other people at 5 to 7% interest. The bank made their spread. You took all the time cost of earning the money, gave up the consumption that would have made you happy, and ended up with a net loss in purchasing power. That's not saving. That's being scammed by people in suits who smile at you on television. Now, you might be thinking, okay, Ian, I understand that savings accounts suck, but I need my money to be safe. I need to to be able to access it. I can't just throw it all in the stock market. That's risky. That's how people lose everything. And I hear you. That's exactly what the financial industry wants you to think. Because the moment you believe that safety and growth are mutually exclusive, they've got you. They've convinced you that the only options are a savings account that slowly erodes your wealth or stocks where you might lose it all. But that's a false choice. It's a binary that doesn't actually exist. In reality, there are multiple asset classes between keep cash under a mattress and day trade meme stocks on your phone. Let me break down what actually happens when you invest your money, because this is where the psychology gets really interesting. Most people have this image in their mind of the stock market. It's chaotic, it's volatile, it's people screaming on a trading floor, losing millions. That image is from the 1980s. It's not how modern investing works. When you invest in an index fund, when you buy the S&P 500 through a low-cost provider like Vanguard or Fidelity, you're not picking individual stocks. You're not trying to beat the market. You're buying a slice of 500 of the largest companies in America. You're diversified across technology, healthcare, industrials, goods, energy. You're betting that the American economy, on average over a long time period, will grow. And here's the thing, that's not actually a risky bet. That's historical fact. Over the last 100 years, the S&P 500 has returned an average of about 10% annually. Some years it goes down 20 or 30%. Some years it goes up 30 or 40%. But if you zoom out over a decade or 2 decades or your entire working career, it goes up. It always has. There's never been a 20-year period in modern history where you would have lost money in a diversified index fund. Not during the Great Depression, not during recessions, not during pandemics. 20 years always wins. But here's what people don't calculate. They look at that 10% average return and they compare it to 0% in savings and they think, well, okay, that's better. But is it really worth the risk? And this is where the actual math needs to show up. Let's use some real numbers. Let's say you're 30 years old making $55,000 a year after taxes. You've got $500 a month that you can either save or invest. That's $6,000 a year. If you put that in a high-yield savings account at 4.5% interest for 35 years until you retire at 65, you'd have accumulated roughly $490,000. That sounds pretty good. 400,000 bucks. That's a real retirement fund. Except due to inflation averaging 3% per year, that $490,000 can buy what roughly $170,000 to $180,000 in today's dollars could buy. You spent 35 years disciplined. You denied yourself experiences and upgrades, and you end up with the equivalent of $170,000 to $180,000 in purchasing power. Now let's run the same scenario, but you invest that $6,000 a year in an index fund that returns 10% annually. After 35 years, you'd have roughly $1.6 million, $1.5 million. That's not adjusted for inflation. In today's dollars, that's somewhere around $570,000 to $580,000 in purchasing power. You quadrupled your wealth compared to the savings account approach by simply choosing a different location for the exact same discipline. The only difference is where the money was. Same person, same sacrifice, same $6,000 a year, completely different outcome. And the difference gets even more dramatic the longer you invest. If you do this for 40 years instead of 35, the savings account approach gives you about $190,000 to $200,000 in today's dollars. The index fund approach gives you roughly $800,000 to $820,000 in today's dollars. You didn't work harder, you earn more. You just moved the money from a place that loses to inflation to a place that beats it. That's the entire game. Now, I need to address the elephant in the room because I know what you're thinking. Ian, what about 2008? What about 2020? What about all the crashes? The people who invested in index funds lost money. Yes, that's true. In 2008, the market dropped about 50%. If you had $100,000 in an index fund in October 2008, by March 2009, it was worth about $50,000. That's terrifying. That's the kind of thing that makes people panic sell and lock in losses. That's the real risk we need to talk about. But here's what actually happened next. By 2013, 5 years later, that $50,000 had become $100,000 again. By 2020, it was worth double what it was before the crash. By 2024, it was worth more than double. The people who panicked and sold at the bottom lost everything. The people who did nothing, who just kept their money invested, came out way ahead. And this is the critical insight. The risk of the stock market isn't that you lose money. The risk is that you panic and make a bad decision during a downturn. The solution to that risk is not to keep your money in a savings account earning nothing. The solution is to understand what you're holding and have enough time that you don't need the money in the short term. If you're 30 years old and you don't need this money for 35 years, then a 50% crash is actually a gift. It means you can buy investments at half price before they go back. The savings account doesn't protect you from market risk. It exposes you to inflation risk, which is slower and more invisible, but just as destructive. There's also this thing called opportunity cost that we need to talk about, because the real cost of keeping money in a savings account isn't just what inflation does to your purchasing power, it's what that money could have been doing instead. Let's say you keep $10,000 in a savings account for 10 years earning 0.1% interest. You end up with about $10,100 in total. Now, what if that same $10,000 had been in an index fund returning 10% a year? After 10 years, you'd have about $26,000. The opportunity cost of keeping it in savings isn't the $1,000 you lost to inflation or the $10 you made in interest. It's the $26,000 you never earned. It's the future wealth you didn't create, and it compounds. That $26,000 is now earning 10% a year too. By year 20, it's $67,000. By year 30, it's $174,000. By year 40, it's $452,000. That single decision to keep $10,000 in savings instead of investing it costs you $440,000 in lifetime wealth. Multiply that by every dollar you've ever saved in a low-interest account, and you're looking at massive generational wealth that just evaporated. And the scary part is that almost nobody does this math. I keep dumping money into savings accounts, wondering why they never feel rich. Think about it in real terms. If you're saving $300 a month, that's $3,600 a year. Let's say you do this for 30 years from age 35 to 65. You'll have put in $108,000 of your own money. In a savings account earning 0.5%, you'd have about $116,000. In an index fund earning 10%, you'd have about $590,000. That's nearly $480,000 in opportunity cost. That's the difference between struggling in retirement and living comfortably. That's the difference between having to work until you drop and being able to retire at 60. That's not just math. That's your entire life trajectory determined by where you put your money. Okay, but we need to get real about something here, because I know a lot of people listening have legitimate concern. You might be thinking, Ian, I've got a mortgage, I've got car payments, I've got 3 kids, I need access to my money. I can't just throw it all in the stock market and hope it works out. And you're absolutely right. You need an emergency fund. You need some liquid cash. This isn't an argument for putting everything you own in a high volatility investment. This is an argument for being intelligent about what happens with your money. The actual strategy most personal finance experts recommend is something called the emergency fund plus investing approach. Here's how it works. First, you build an emergency fund of 3 to 6 months of expenses. If your monthly expenses are $3,000, you're looking at $9,000 to $18,000 in liquid savings. That money stays in a high-yield savings account. It's accessible. It earns a little bit of interest. It's your cushion if something goes catastrophically wrong. This is your insurance policy. Your car breaks down, your furnace needs replacement, you lose your job for a few months. These scenarios don't destroy you because you've got 3 to 6 months to figure it out. And critically, that money is earning at least something. Maybe 4 or 5% if you choose the right high-yield savings account. It's not going to beat inflation over the long term, but it's better than nothing, and it's there when you need it. But that's it. That's the only money that should be sitting in a low-return savings account. Everything else, every dollar beyond your emergency fund, should be working. Once you've got your emergency fund set up, here's where the real wealth building begins. You've got multiple options depending on your risk tolerance and time horizon. If you're under 50 years old and you don't need the money for at least 10 years, you should be in stock-based investments. There are several vehicles to use. If you have a job that offers a 401k, that's your first stop. Contribute enough to get the full employer match. If your company matches 3%, contribute 3%. That's free money. It's like an immediate 100% return on your investment. Once you've done that, open a Roth IRA. You can contribute up to $7,000 per year and it grows tax-free forever. That's an incredible tool. If you've maxed those out, open a regular taxable brokerage account. The order is 401k, Roth IRA, taxable account. For all of these, the simplest option is an index fund tracking the S&P 500 or a total market fund. You could spend 2 hours researching and pick individual stocks, or you could spend 20 minutes, buy a single fund, and come out ahead of 80% of professional investors. I know which one I'd pick. If you're closer to retirement or you're more risk-averse, you can blend it. Maybe 70% stocks and 30% bonds. Bonds are less volatile than stocks. They pay a little interest. They don't return as much over long periods, but they cushion the ride. If you're in your 50s and closer to retirement, maybe it's 50-50 or 40-60 stocks to bonds. The key is that you're investing based on your time horizon and your temperament, not based on being afraid of the word stock. There's also this misconception that investing is complicated, that you need to pick individual stocks or work with a financial advisor or study earnings reports. It's not. If you have a 401k at your job, you're already investing. If you open a Roth IRA or a regular brokerage account and buy a single index fund, you're set. You spend 20 minutes setting it up and then you literally do nothing for decades. You don't check it, you don't panic sell during crashes, you just leave it alone and it works. This is called passive investing, and it's genuinely the best kept secret in finance. The average actively managed mutual fund, where professional managers try to beat the market, underperforms a simple index fund about 80% of the time over 10-year periods. All that expensive management, all that expertise, and they still lose to a machine that just buys and holds the index. The only person who's beating passive index investing consistently is someone with insider information, which is illegal, or someone who got incredibly lucky. So the question becomes, why would you ever try to beat that? Why would you ever do anything other than putting your money in a low-cost index fund and forgetting about it? The answer is that most people don't understand this, and the financial industry doesn't want them to understand it, because a person who puts their money in a $10 fee per year index fund doesn't generate commissions, doesn't create job security for financial advisors, doesn't justify expensive newsletters and premium investing apps. So instead, they keep telling people that savings accounts are safe and investing is risky, when the actual truth is the opposite. Think about the incentive structure. A bank makes money when you deposit money at low interest rates and lend it out at high interest rates. The bigger your savings balance, the better for them. They get essentially free money to deploy. A financial advisor makes money through fees or commissions. They need you to believe that you need their expertise, that investing is too complicated to do. Yourself, that you need to pay them to manage your money. An investment company selling actively managed funds makes money from management fees. They need you to believe that someone can beat the market through skill and expertise. All of these incentive structures point toward the same conclusion. Keep the money in savings. Keep it safe. Don't invest it yourself. And if you must invest, pay someone else to do it. None of these incentives align with you actually building wealth. They align with capturing fees. The only person whose incentives align with your success is yourself. When you buy a $10 per year index fund, you're the only beneficiary. That's why it works. Let me give you a framework for thinking about this, because it ties everything together. There's a concept in investing called the risk-free rate. Traditionally, this was the interest rate you could get on government bonds or savings accounts. The idea was that if you could invest in risk-free assets and make 3 or 4% return, then you had a baseline. Anything below that, you were losing. Anything above that, you were winning. But here's what happened. Interest rates got pushed to zero by the Federal Reserve for nearly 15 years. And then inflation came roaring back at 4, 5, 6, 7%. Suddenly, the risk-free rate was negative. You were literally guaranteed to lose money if you took the safe option. This is the trap we're in right now. The safest thing in traditional investing, the thing that's backed by the government and insured by the FDIC, is now a wealth destroyer. So the question isn't whether you should invest. The question is whether you can afford not to. If you're keeping money in a savings account, earning next to nothing, while inflation is 3 to 4%, you're making a choice to lose money. You're making a choice to be poor. It's not dramatic, it's not exciting, but it's true. And here's what really gets me about this situation. We've been sold this narrative that saving is virtuous and investing is sinful, that saving is responsible and investing is reckless. It's literally backwards. backwards. Saving is the thing that slowly destroys your wealth. Investing is the thing that builds it. The financial system has inverted the actual reality in our minds. And because the system is trusted, because it's backed by institutions and government insurance, we believe it. We feel safe keeping our money somewhere that's guaranteed to make us poor. Meanwhile, the actually risky thing, the thing that requires discipline and long-term thinking, is the thing that builds wealth. It's psychological judo. They've used our fear against us to keep us in a position where we're doing the thing that benefits them and hurts us. The banks get to borrow your money at 0% and lend it out at 5 to 7%. You get the crumbs, and you feel grateful for it because it's safe. So let me leave you with this. If you're someone who's been religiously saving money in a bank account because you think that's the responsible thing to do, you've been making a choice. You've been choosing to let inflation steal your future. You've been choosing to work your entire life and end up with purchasing power that's worth half of what you thought. You've been choosing poverty, slowly, 0% interest month at a time. But you don't have to keep making that choice. The solution is not complicated, it's not risky if you do it right, it's not something you need to be a financial genius to understand. You build your emergency fund, you set up an index fund, you invest money monthly just like you were saving it. You do nothing else. You check back in 5 years, 10 years, 20 years, and you find that you've built real wealth. You've beaten inflation. You've actually gone from being broke to being rich. Not because you worked harder or made more money, but because you moved your money to a place that works. The system wants you to believe this is too complicated, too risky, or not for people like you. Don't believe it. Run the numbers yourself. See how much wealth you're leaving on the table every month you keep money in a savings account. That anger you feel when you see those numbers, that's the feeling you need to hold on to. That's the motivation that actually creates change. This isn't about gambling. This isn't about taking crazy risks. This is about accepting historical reality. The stock market has been up 75% of the years for the last 100 years. If you have a long enough time horizon, the math works. If you're under 50 and you're still saving in a bank account, you're not being safe. You're being foolish. You're leaving your future on the table. And the kicker is that you're not even that much safer. You've only delayed the loss. It's just happening slower. Through inflation instead of through market volatility. At least with market volatility, you get the chance to bounce back. With inflation, you're guaranteed to lose. If this video helped you see your savings account in a different light, smash that like button and subscribe for more content that actually challenges the financial narratives you've been sold. Share this with someone who thinks savings accounts are still a good idea. We can do better. I'll see you in the next one.